All right, guys, we're back with another Wise Wealth. Today, we're going over derivatives and futures. So, what is a derivative? It's basically a financial contract that derives its value from an underlying asset, and the contract is an agreement between two parties on to buy or sell a whatever the asset is at a certain price in the future. Or actually, no, I'm sorry, not in the future. It could be. It's just an agreement to buy or sell something between two parties. And the price of derivatives are based on fluctuations from the price of underlying assets. And usually derivatives are used to hedge against risk, aka mitigate risk, or you can use derivatives to speculate on price, which you're risking more. And the most common derivatives are futures, options, forwards, and swaps. Most common underlying assets, we have interest rates, bonds, stocks, commodities, currencies, indexes, basically anything you could think of. And derivatives are usually used with leverage, so you're able to gain more money or lose more money since you're borrowing from the broker. And they might ask, what do derivatives trade on? They trade on the Chicago Mercantile Exchange, or the CME, which is basically like the New York Stock Exchange for derivatives. And derivatives contracts usually have an expiration date. Now, futures. No, it's not the rapper Future, even though he's a great rapper. It's not what we're talking about. But a future is basically a legal agreement to buy or sell a security at an agreed upon price in the future, which is why they're called futures. A buyer of a futures contract is obligated to buy and receive the underlying asset of the futures contract upon the expiration date, and the seller of a futures contract is obligated to sell and provide the asset from the expiration date. Futures allow investors to speculate on the future price of whatever it is, either whatever commodity it is, by using leverage. So futures could be, you could have gold futures, livestock futures, grain futures, oil futures, NASDAQ futures, whatever you want. And they're regulated by the Commodity Futures Trading Commission, or the CFTC, just like how the SEC regulates the stock exchange. And within futures, we have two types of investors. We have hedgers, which purchase or provide futures contract to ensure that they have a buyer or a seller at an agreed upon price to negate any changes in the market, then mitigate their risk. Or we could have speculators who bet on the price of an underlying asset with the futures contract, either the price to go up or down. For example, you might buy gold futures if they expect the gold price to rise due to a war or a bad economy or whatever it is. Types of futures, we have agricultural futures. These include grain, cattle, lumber, milk, coffee, sugar, like whatever you want, pretty much wheat, like anything that you could think of agriculturally. We have energy futures, which is oil and gas. Metal futures, so we could think silver, gold, platinum, whatever you want. We have currency futures, which is essentially you get exposure to different exchange rates between foreign currencies. And we have financial futures, which is contracts that trade in the future value of a security or index like the NASDAQ or the S&P 500 or the Dow Jones or whatever you want. And let's do an example of a futures contract. Now, let's say we have XYZ Oil Corporation and they plan to produce 2 million barrels of oil in the next 6 months. The current market price of oil is $60 a barrel. So if they were to sell their 2 million barrels right now, they would get 2 times $60 per barrel times a million. However, the market price of oil could be higher or lower than 60 in the next 6 months because that's how the market works. Prices shift, etc., etc. So let's say XYZ Oil thinks oil prices will be less than $60 in 6 months. Meaning, if they were to, if they didn't buy, or if they didn't engage in a futures contract, in 6 months, let's say the price per barrel was $50, they would be losing $10 per barrel had they not engaged in the futures contract. So let's say they think it's going to be less than 66 months. They can lock in a futures contract that allows them to sell the 2 million barrels at $60 per barrel, regardless of whatever the market price of the barrel is. So If the market price per barrel is lower than 60, they made a good choice since they're now going to be selling their barrels above market price. If the market price is above 60, they made a bad choice because they have to sell their barrels below market price. Now, futures contracts are standardized, meaning a contract has X amount of underlying assets. So, for example, one oil futures contract might have, say, 1,000 barrels as the underlying asset. Now, per contract, XYZ Oil Corp, since they're selling their barrels, they must sell 1,000 barrels for however many contracts they purchase. Now, that was an example of a normal contract. Now, I'm assuming most of you guys are not going to want 1,000 barrels of oil or ever need 1,000 barrels of oil or ever need 50 million cows, whatever it is. You're probably going to be trading futures. So, for example, like I said, you might not want or need this many X whatever commodity. So instead, you might want to profit off the price changes in, say, oil, gold, livestock, whatever. So in order to do this, you must close the trade before the expiration date. Most futures contracts expire on the third Friday of the month. Same with options. Now, how do you actually trade futures? So let's say the month is January and you do a 3-month futures contract that expires in April on the third Friday that says gold is trading at $2,600. Now, you believe the price of gold is going to go up before the expiration date. So, what can you do? You can buy gold futures. Now, one gold futures contract is equivalent to 100 troy ounces of gold. So, now, essentially, with the futures contract, you're gaining control to 100 ounces of gold. So, how much money are you essentially controlling? If 1 ounce is 2,600, 100 times 2,600 per ounce equals $260,000. Now, you're going to say, well, I can't trade this because I don't have $260,000 to put. Well, what you do instead is your broker will allow you to trade it, but you have to put up an initial margin with your broker to open the trade. And while the trade is open, you need maintenance margin. Why do you need maintenance margin? Because sometimes your losses may exceed your whatever balance, so you need some sort of collateral or margin, your maintenance margin, while the trade is open. So let's say the final price of gold goes to 2,700. How much are you going to profit off of it? So the difference between 2,700 and 2,600, it's a difference of $100 per ounce, and you're controlling 100 ounces. 100 times 100 equals a $10,000 profit or loss if the price, say, goes to 2,500. It's extremely important. I cannot stress this enough. Although this sounds very good, you could make a huge profit if you play your cards right. You can also lose the same amount, if not much more. So, yes, while futures allow you to control a large amount of assets, keep in mind that you're also eligible to lose that much. If your losses exceed your margin, you may be margin called by the broker and have to deposit more money to cover your position, or the broker will just liquidate your assets that are necessary to cover the cost. Overall, futures, can be an amazing way to make big profits and also to hedge your risk. But like I said, this is probably the most important thing of this. Just because you can get big profits doesn't mean you won't lose money. You can probably lose much more money than you can gain. Like I said, big profits also equivalent to big losses. Goes both ways. But yeah, you can trade futures on certain brokers, and it usually requires more money or more margin. And it's say if you were to just buy 5 shares of Apple, obviously you're gonna need more money. But there's certain ways that you could do this, and essentially futures just allow you to control a much larger amount of assets versus if you were to just buy like 5 shares of whatever. So yeah, that's why futures are good. The type of derivative. Let me know if you guys want me to make a video about options. Options are sort of the same thing, but a little bit more complex. I'll make a video about swaps coming in the future. I don't remember the next one. So yeah, the next video is probably gonna be swaps. Um, but yeah, that's essentially what futures are. You can control a large amount of money by putting up only a little bit of your own, but you can also lose a very large amount of money. So it's risky stuff. So anyways, hope you find this video informational. Thank you for watching, and the next video will be about swaps.